Hello everyone, welcome to another lovely episode with Forex House. On this episode, we would be going into the re-accumulation. All right, so I hope you guys had a nice understanding from the previous episode, where we talked about the redistribution. And I gave you guys a breakdown from a live analysis I took on the Telegram community. Unfortunately, I won't be doing same on this one because I have been away for the past um with the previous week, and I didn't share much analysis in the group before I made this video. So we don't have any layout to analyze. So I'm just going to be giving a breakdown of the reaccumulation schematic and also giving you an insight into the cause and effect theory when it comes to trading Wyckoff on charts. So the cause and effect theory is not kind of like different from the original concept itself and how it's being used on the chart. Is basically the same thing. Cause and effect is the same everywhere. Just that when it comes to using it on charts, it's kind of like different to identify because you're kind of looking for a replica or a representative of the cause. So you can also predict the effect and how it's likely to look. So when you're using the charts, it's a little bit difficult to understand these principles, but they are basically the same thing. So currently I'm reading from the ebook, which if you like to get the ebook is free. The link is in the description of this video. I made this ebook breaking down the Wyckoff concept. So we have the concept already on ebook file. For those of you who are learning Wyckoff from this series, you can have this ebook as kind of like a guide to you when you're watching this video. Then you can go back to the ebook and then, do your own personal research and homework to how you practice this method on the real life chart. Okay, so the law of cause and effect is one of the principles governing the laws of Wyckoff and how it works. I was supposed to start from the law of supply and demand, but I noticed I did a breakdown of this already on the episode 1. And if you want to get more insight on how supply and demand works, you should go to the episode 1 of this Wyckoff series, and then you can watch that. It gives you a lot of insights to how to look for supply and demand zones and also how they are represented in terms of Wyckoff. So we have the laws of cause and effect, which this principle states that the length of the price movement is determined by the size of the accumulation of the distribution. And this I've been explaining earlier that we have the accumulation 1, 2, 3, distribution 1, 2, 3, and all of that. So when you see things like this, they're talking in general. This also covers both reaccumulation, redistribution, and all of that. So the size of the consolidation, which the schematic formed, be it accumulation, redistribution, reaccumulation, or redistribution, the length of it determines the effect of the markdown or the markup or the continuation that follows that particular schematic. So as you all know, the reaccumulation and redistribution happens on a continuation trend, while accumulation and distribution happen on reversal points. So the concept is basically saying this: the length of the accumulation that happens, would also tell you, let's say this was a redistribution coming from a downtrend. Let's use that since we just recently studied what a redistribution is. And from this consolidation, we are expecting price to continue downwards. Okay. So you're like this same price action has a higher time frame area of interest around this zone. Okay. So let's say this was the weekly and this was within the daily. And then you're looking for price to drop to this point. Okay. So you're looking for price to drop to this point, and you're likely seeing a redistribution happening at that area. So you're now asking this question: is this distribution going to be taking this long, or will it just drop to the length of this point and then, start up? Or will it instead be, heading towards a much lower price? So how do you know this? How do you determine this? This is where the law of cause and effect comes in. Okay, so cause and effect is trying to give you an insight to understanding how and where the length of this redistribution that's happening here is going to be going. So the law says if this distribution is big, let me just use those terms so it's easier to understand. If it's very big, you are expecting a big reaction then, you know. But if it's not that big and it's small, let's say it's just small from here to here, then there's every possibility that is a small markdown that would follow after it. And then this markdown could be riding into that higher time frame area of interest, which you might be waiting on. Okay. So the law of cause and effect helps us to tell the length of the trend that is coming next and what to expect. Okay. Why supply and demand helps us to tell areas like this and areas around here where price is likely to give a U-turn or a spring into. Okay, and also it also helps us to tell what structure is doing. Basically, supply and demand tells us where to find key levels as well. So this is what this is used for, mainly when it comes to chart. And then the law of cause and effect tells us the length based on impulsive and corrective moves. So I'll probably in one of the next episodes, I'll also break down impulsive and corrective price action. But that particular concept comes in from Elliott wave. It's not really that's mentioned in Wyckoffs in terms of Wyckoffs, but I don't like to discriminate, since I used the trade concepts and I'm familiar with most of these concepts. So I prefer to just, use what works for me. And the law of impulsive and corrective moves just explains the law of cause and effect in a more understandable way because price moves in impulsive or corrective price action. So if it's correcting, then it's either a retracement or price is mainly a retracement. Low momentum is correcting, high momentum is impulsive. So if it's on a low momentum, then there's every tendency that is, and it's an uptrend, you expect low momentums on retracement. Okay. So how does this play a role in Elliott wave? In Elliott wave, we lose the wave patterns of A, B, C, D, 1 to 3. So some of those wave patterns are corrective moves. Some of those wave patterns are impulsive moves. So you know what to look for when you're looking for any of them. In the Elliott wave mentorship, we'll go into that. But in minor common structure, when looking at structure with this principle of impulsive and corrective move, you understand that when it's retracing, it's supposed to be in a corrective price action. We will be heading to the charts very soon, so we'll also explain this on chart, a quick explanation so we get what we're trying to say. And then when it's in the direction of the trend, when we see price in the direction of the trend, it's likely an impulsive price action. So when it's retracing and it's trying to get a pullback, we see corrective price actions. So these corrective price actions are what we call consolidations. And within this, if it's correcting, it's where you're expecting a schematic to happen because if it's impulsive, it's a markup. If it's corrective, it's a markdown. But if it's impulsive, it's a mark to the upside, it's a markup. If it's impulsive to the downside, it's a markdown. But if it's corrective and the trend is bullish, then this is a reaccumulation. If it's corrective and the trend is bearish, it's a redistribution, because these are continuation patterns. But when it's time to reverse and head a new direction, then within this area is where we find accumulation and distribution. Okay, distribution is the opposite of the accumulation. The accumulation is when price is turning from bearish to bullish. So accumulation is down, distribution is up. But reaccumulation is on the sideways when we are going up. Redistribution is on the sideways when we are coming down, just like how we said in the previous episode. So for you guys who are not familiar with the Telegram community, there's a community on Telegram where traders share their insights using different methods. Most of them are learned within the community as well. So you can also learn and get familiar with your own method of trading by just joining the community on Telegram. Link is also in the description. And you get access to all our ebook files within the Telegram channel, which is linked to the community. So all those links are the same in the description. So let's head on to the chart. Let's give a little breakdown. I'm not going to be giving much breakdown on the accumulation schematic because, like I said earlier on the previous video, it's simply a flip. Okay, it's simply just a flip of the redistribution. So if you understand the redistribution, you just flip the concept. And then when you're in a bullish trend, you expect a reaccumulation. When you're in a bearish trend, you expect a redistribution. But the schematics are similar, very, very similar. And they are all also within the ebook, which you can get with the link in the description. So let's look into what we call the impulsive, corrective, and cause and effect. So basically, when it comes to understanding cause and effect, although this is a very, very whack price action, this is very, very whack concerning um, highs and lows. This is a very, very whack price action. But let's say this is a corrective move. So let me show you corrective moves. These are corrective moves. Corrective, corrective, corrective. These are corrective moves. If you pay attention, you would also see when these moves switch bullish. You see kind of like a pattern change in them as well. This is a corrective move. So when you identify these corrective and impulsive moves, from here you can now tell um, where to find the accumulation and the distribution and all these patterns. Because if you now look at this, you can easily then identify um, the highs and the lows of the trend. Because this would be a high, this would be a low, a high, a low. Remember I told you price moves in corrective and impulsive price action. So if there's a corrective move, the next would be impulsive for that corrective to end. Do you understand? If the move was corrective, the next has to be impulsive for the move to end. So when you see something like this, where is the impulsive moves? Have you been able to spot them? This was impulsive. You can see the momentum as well, and it was in the direction of the overall trend, which is bearish. This was impulsive. You can see it's one-sided and it takes shorter time to happen. These were corrective moves, but also impulsive as well, because the entire price action was chubby. I believe it was because price was currently approaching a higher time frame area of interest. Because from what we can see here, looking at the impulsive and corrective moves of the price action, we can see price was basically getting ready for an accumulation. Okay, so this is a turning point. And with this being a turning point, means an accumulation is likely involved at this area. Okay, so there's likely an accumulation at this area. And if you pay attention to the movement of the candlestick, for me, I'm already seeing it clearly. I can clearly identify it just by looking at it. If you have been following up with the mentorship, you should probably know what we are looking for now as we're looking at the chart. And this move, this low price action here, tells us the build up to the accumulation to expect. For example, now these little price actions are on the lower time frame. If you look at the trend, you're going to find something like this. So you see, using corrective and impulsive, we just identified market structure in the most cleanest way possible. Like the most cleanest way possible, we just identified market structure. So the length of this redistribution that happened here, because as you can see, this is not a turning point and this is a downtrend. So this consolidation is a redistribution. And then if you're likely to bring out a schematic and look at this, you clearly see this is a redistribution. And you can see how I am identifying these concepts without putting on the AR, ST phase B, SOS, tests, last point of supply, last point of supply. I'm just simply just doing this by knowing the principles that are behind them, the laws, where to find them. Okay. But if you use those words, you will still get it right. But you have an easier chance of understanding Wyckoff by going it from this point of view. So you can easily understand what the entire structure is doing. Because right now, we just give details to what's happening from this area to this area without having to know where is the order block, where is the breaker block, where is the fair value gap, all of those stuff. Just by simply looking for certain rules and regulations that are working with market structure. Remember, market structure is key and the trend is your friend. So you have to work with market structure and the trend to be able to get the next direction. Okay. So using this, you can see we had a little redistribution here, which means we're going to be having a little effect. So if you look at this, we have this redistribution, this effect. From this point was where another redistribution started. Okay, this is also a redistribution schematic. I think about the distribution tree or so. Why I say so is because you can see liquidity was accumulated at this point. We can see also a schematic happening here. Okay, so you see high, low, high, spring, but because this is a downtrend and a continuation pattern, when you see springs like this clearing out liquidity, if this was a reversal point, then we'll be expecting an SOS from here to clear out this high to confirm a break of structure. And then we expect price to, give a retest and price go up. But because this is a continuation of a downtrend and this was a redistribution, you can see what happened. We had this sign of weakness and then price returned to give a test. This was a test and this was the last point of supply. You can see it testing the 50% of the range. Price broke structure again, gave a sign of weakness again, and then tested the closest supply zone. So this is where supply and demand concept comes in. So it tested the closest supply zone here, which also gave valid to the next structure. Then we had the follow-up that built liquidity at this area. Then there was this manipulation that cleared out that liquidity. If you want to see the accumulation, the redistribution that happened at this point, sorry about that. You can also see it from here. Okay, so this was an entry point. All right, and then from this area, you can also see that we start seeing change of structure happening, and we had a clean break of structure here, which was a change of character. Okay, we had liquidity. You see, now I have no problem spotting the smart money concept in Wyckoff. Why? Because I don't discriminate between which concept is which concept. I'm just looking for how to make sense with market structure. And once I have the direction and my principles are aligned, I can easily flow with whatever concept or whatever I see on the charts. And I can tell whatever is happening because I can flow between concepts and give you an insight to what I see. So from here, we can also see this as PS, AR, ST. So because I'm kind of like familiar with Wyckoff, I don't have to always bring out the schematic in front of me to tell what's going on. So this is and accumulation 2. Remember, I told you guys that the accumulation 1 has a spring, the accumulation 2 doesn't. So it's not every time an accumulation is done, you see the spring. Sometimes you just get the test and the structure is expected. So this is why we have 1, 2, and 3. They don't have much difference, but these stuffs are kind of like needed to help you understand what's going on. So you have the last point of supply. And voila, that easily I have identified what's going on and gave multiple confirmations to what area of interest I might be looking at. And then with this, I would have this as the accumulation. So you see, I just gave you insight from what's happening from this area to this point, coming from the principles, understanding the cause and effects with using premium, impulsive and corrective price action, then identifying the swing point of the structure. Then I gave you the insight of the follow-up from the markdown, because on the phases, this would be a markdown on the higher time frame, an accumulation, then a markup. So this is clearly an accumulation. So I gave insight from the markdown, how the redistribution followed up, and then an insight to how the structure changed. This would be our phase C, because we remember phase B ends after the spring. But this is a reaccumulation too, so there's no spring. And then the phase B started with the manipulation, where price get out highs, giving a sign of, an SOS. We have the phase A, where the initial accumulation starts, and then the phase C, where we get an entry on the last month of supply. Then phase D, the markup can then continue. So you see, Wyckoff is not that difficult to understand. It's very, very easy. Once you know the principles and you know where to find the schematics, you are very good to go. So from this episode, I believe you guys are beginning to have insight to how Wyckoff works. And I just gave you guys insight on how to identify it. I believe you can now start taking little steps on your own to try and see if you can, identify them on charts. This is why we have the Telegram community. So you can use that as your practice team. You learn with them, you share your experience, and then you have others give insights to what you think. And you can also get direct corrections from me. If you're lucky and I'm online at that period, I will give you my insights on what I think from what you identified and what you're doing. So for those of you who might want to see a schematic to see how correct this I identified is, I'm about to put up the accumulation 2. Here we go. So if you look at this, you see the insights to how I got the test, and the follow-up. You see? So the SOS comes in from this point. All right, so the SOS comes in from this point. But on this particular schematic, you can see they gave the SOS on this point. It doesn't matter. That's why I say it's not the pattern that matters. You don't have to find exactly this. An SOS is a sign of strength. So you want to see a sign of strength by price breaking the previous trend. Okay. So as you can see, it happened on the first area after the second secondary test that cleared out the buying climax, the selling climax, sorry. So yes, this is the selling climax here. So I didn't identify that. But on the lower time frame, on the 1 hour time frame, this schematic will be much wider. And then you'll be able to give a bigger insights to what's going on in the lower time frame. Okay. So as you can see, this is the AR, then the ST. So I gave this on this point before this happened. That's why I said on the schematic, it happened before the ST, but on the live chart, the SOS happened after the ST. It doesn't matter, it's a pattern. It's a pattern. And patterns can change over time, but the principles will remain the same. It will be easier for you, it will be easy for you to spot as long as you know the principles and how to look for them. Okay. So this is how it looks. And this is how you can identify it easily. and very fast while using the Wyckoff method. All right, so this is an example trying to let you guys have a clear insight and a direct view into how this stuff looks like. Okay, so those of you who have questions, you can leave that in the comment section. You can leave your questions in the comment section, and I will help you out in answering that as much as possible. So for the cause and effect, it's very, very simple. Okay, it's very, very simple. You just have to look for the schematics and the consolidations that caused uh, the effect of the markdown or the markup. Okay, so once you find the consolidation, you can tell at what length the impulsive move go. So you can then look at the next range and the length of that next range to know what to expect on the coming one. So the length of this one tells us the movements of which this one went, and then this one gives us the insight of which. So these are little accumulations, and then the length of this one gives us insights to this one, before the next reaccumulation happened here, gives us insight to this one, and then price continues to go on from there. But from this point, you understand that on a higher time frame, you would see a bigger accumulation while this schematic is playing out on the lower time frame. So, or probably on the 8 hours time frame, you will see a much insightful chart on the details happening at this area. But cause and effect plays on every time frame. As you can see, we had a corrective price action, which gave insight to this impulsive move over here. You see this corrective price action as well. We had this move over here. So this move tells us how much of a retracement to also expect. So this is all normal. Okay, so it's not like because the principles are identified individually, you're supposed to look for them on different charts. No, it's the same thing. It just gives you insights to where to expect the next move, what to expect next, and then how to use all the principles together before looking for the schematic, so you know what you're looking for and what you're looking at the same time. So thank you for joining us on this episode. This is a short one. On the next episode, we'll look more into live charts and more analysis too. So thank you for joining us. Bye.